Hey traders, this is Christian from Tribeca Trade Group with your weekend video. So quick recap of last week. Well, we know we had an equity breakdown here. SPYs were down close to 2%. The Dow was down 1.5%. IWM down close to 2%. Qs really picked up to the downside. They were down 3%, and bonds and gold rallied. So we have a very big event coming up on Tuesday, this little thing called the election, and we've seen volatility really pick up going into the election. It's now 22:51. We know that the market does not like uncertainty, so there's quite a bit of uncertainty going into Tuesday. And what I'm looking at is, I'll start off with an election trade here on this video. And what I'm looking to do is sell the VXX December 40.44 call spread. That's a credit spread. And I'm looking at collecting $1.08 on this trade with total risk of 292, which is your the width of your strikes minus the premium that you're collecting. So why am I looking to do this? Well, Tuesday, whether we like it or not, we are going to have a winner in this election. And uncertainty, we are going to know what that event is going to be. We are going to know what the winner is. So that should take some volatility and some uncertainty out of the market. Now, it's not going to be as clean as other elections because we don't know if the candidates are going to debate the result afterwards. We also have an FBI ongoing investigation. So it's not going to be as sure thing or as clean as previous elections. Nevertheless, we will know who the winner is. And I think that some volatility should come out of the market, as well as uncertainty coming out of the market, which is what equities do not like. So being that we still have a couple of things in place here, I don't want to go to November, but I'd rather go to December to sell that VXX call spread. The VIX or the VXX does go down over time. All you have to do is take a look at a five-year chart of the VXX, and you could see that they continuously have to have reverse splits. So this is, the VXX was never trading at 3,000. They just have to continue to give it reverse splits over time. If I draw an even closer here, you could see how this product is just flawed. So anytime that there's a move up in volatility, I do like to sell the VXX call spreads to collect premium. So that's my first trade, and that is what I'm looking at. Looking at some technicals, as I mentioned, we did have a breakdown in equities. If you look at the weekly chart of the S&P, the level that I've been concentrating on to see if we would hold, which we did not last week, is 2117.5. That's top of the yearly value area. For the uptrend to continue, the S&P needs to continue to climb or to get back above that level. And that's when we'll know whether we're back in an uptrend. So for right now, it is what it is. We're not in that uptrend anymore. We've broken down. However, there's a couple things to watch here. Number one, the 200-day moving average. Whether you watch the S&P futures or if you watch SPY, you could see that the white line is the 200-day moving average. We'll see if we can hold that. That's going to be a big question for me, whether or not we can hold the 200-day moving average, which we're right there right now. A few other observations that I note here is that the RSI, so the relative strike index, is under 30. That's oversold. The indices, in my opinion, do not stay in that area for long. If you go back and you look at history, if you look at February, we stayed oversold for a little while here. As we made this W pattern, we've hit it a couple other times here. Notice as soon as we hit that 29.30 level, we usually bounce right back. So it's not always the case, but it happens more often than not. So that's something to watch. We could be set up for a short-term bounce next week, I think, after the election occurs. Another area that I'm watching is I continue to watch small caps. If you watch my previous videos, and if you're a member of Tribeca Trade Group, you know that I always talk about small caps leading the overall market. And that was the first warning sign that we saw, was that the small caps broke down in front of large caps and in front of technology shares and NASDAQ. So what we saw on Friday was a little bit outperformance in small caps. They were up 65 basis points. Not the best looking candle in the world, as that move got faded, but we still ended up 65 basis points. So one day is not a trend, but that's something that I'm watching next week, is if those small caps start to lead the large caps, if they lead the SPY or if they lead the Qs. I think that would be a very good signal for the market. So the 200-day moving average I'm watching in both IWM and in SPY, as well as I'm watching those small caps to see if they will go ahead and start to lead us higher. or to lead a particular possible balance. The next thing that I'm watching, also you could watch Bollinger Bands as well. I bring up the Bollinger Bands whenever we have an extreme movement. We're outside a 2 standard deviation Bollinger Band. So again, pretty extreme move that we've seen in the last few days or in the last week. Note that we're about 5% from the all-time highs in the S&P. So a decent little correction that we have on our hands. Looking under the hood at U.S. sectors, you could see from last week, we had a couple of the leaders still holding on, tech and financials. Well, they've all broken down as well. So we now have, out of the GIC sectors, U.S. sectors, we have 6 sectors that are now below the 200-day moving average. Interesting that you look at some of these, and a lot of these are the defensives. This is what I've been talking about for the last few weeks, that the defensives were not going to save us here because they've been pretty built up over the last year. So you have utilities, REITs, telecom, consumer staples, now all under the 200-day moving average. Pretty interesting how those defensives are actually down more than anything else. And financials are the only sector that's between the 50-day and the 100-day moving average. Everything else is kind of in no man's land or below the 200-day moving average. However, some sectors that are not the GICS sectors are showing some relative strength here. So what's nice about equities and the market is there is always something that you can find to trade. So what I find particularly interesting right now, and a positive sign for the market, while we're down 5% from the all-time highs, we don't see a breakdown in everything. We don't see a breakdown in transports. They're actually very, very strong looking. They're above the 50-day moving average. We're also seeing the base metals outperform and actually break out here. That's the DBB ETF. That's your copper, your aluminum, and your zinc. Very strong here, and is the stocks in that area are reacting pretty well. That's the Xme ETF that I've been focused on for the last couple of weeks. I'm also watching names like U.S. Steel, which we've seen continuous call buying. Going all the way out to April, even though they had earnings that I thought were pretty weak. We're still seeing call buying in that area. We're also seeing call buying in FCX, which is very much tied to the move in copper. So what I'm watching for next week, besides the 200-day moving average, I'm looking for us to reclaim 2117 in S&P futures or 2112 in SPY. Things like an MACD crossover, the VIX back under 20s, and some of these U.S. sectors to go ahead and reclaim the 200-day moving average. ETF fund flows for last week. I always talk about these. I always look for hints in what's going on. Just really, really big outflows going on in the high yield bonds. They had $1.8 billion in HYG and JNK alone. Other than that, in U.S. sectors, pretty risk-off tone going on here. Only utilities saw inflows. Industrials, tech, consumer discretionary, all big outflows for the week. We snapped a 2-week streak of equity inflows. We lost $5.2 billion. So this is kind of on par with a 5% correction. Seeing some equity outflows here. So that's something to watch next week. I do have another video on the Xme ETF. That's short-term treasuries. Those are seeing inflows. We tend to see this. I'm not going to go over that whole analysis because I do have a separate video on that, but we're starting to see a lot of short-term bond flows. Short-term bond funds gather assets here as volatility goes up. Another ETF that I'm going to go to next, which is TIP, is seeing a huge amount of inflows as investors look like they are expecting inflation on the horizon. So TIP saw $1.1 billion in inflows just last week. You can look at a chart between what's going on with the price versus what's going on with investment. The white line is investment or outstanding shares. You can see this big, massive investment going into the TIP ETF. Again, this is Treasury inflation protected securities. So this is an area, while there's no options in TIP, this is an area that you might want to look at in cash. As I mentioned, Copper, copper a couple times has tested. This is the weekly chart of copper. It's tried to break into the yearly value area. 2.29 is what you want to watch in copper. So it's testing. It's basically this whole time frame on the weekly chart over about a month. It could not get in here, could not get in here, could not get in here. So making another attempt at trying to get into the value areas copper. So I think that's a must watch for next week or for the next couple weeks. Base metals, I talked about these breaking out after a big decline. Xme Etf looking pretty positive here. Like I said, we saw buying in cash. We saw a couple big blocks go up. And I'm looking for a move to 28.75. That's the top of value on the weekly chart. That's where we stalled out back in July. I'm also watching the Raptor indicator for a positive crossover. I'm also looking at FCX Freeport. 1061 is the level that I think you can that I would be looking to trade against, to go long against. That's your support area. And then finally, if you're looking for a bearish trade, while I'm not really looking to short the market right now, we've already had a 5% decline. I think it's also a positive sign. Some of these perma bulls are now out on Twitter and financial media saying, sell everything now. And, you start to see people running for the hills a little bit. You want to be buying equities when no one else wants to, when everybody's getting very frightened and scared of what's ahead. And I'm starting to see that. I'm starting to see a lot of people who were ultra bull technology, and now they're talking about they don't want to be in technology anymore. So, I think that's positive. For me, I don't want to be in the market when everybody's positive. So it looks like there's some fear in the marketplace going on right now. However, one short which I think is particularly interesting, if you look at what's been going on in coffee, it's been very strong, and we saw an interesting order on Friday. We saw a pretty big block in Dunkin' Brands. This was 7,400 of the March 45 puts. So going up to March, it's about a $1.6 million trade. So also, just like IWM and SPY, Dunkin' Brands is right at the 200-day moving average. If this breaks, I think this could be setting up for a nice short. So we do have some stocks to watch. You have to be a subscriber to the Tribeca Trade Group. Please go ahead and check us out here, tribecatradegroup.com, and go to products. And depending on what kind of investor you are, if you're a full-time investor, you can get involved in our trading plan. We go over this type of analysis every day in our trading room. If you can't be in the trading room, what I would suggest you do is go to our option swing program. You can get our weekly newsletter as well as our videos, as well as option swing trades that you can get real-time alerts for. So go ahead and visit us at tribecatradegroup.com. And thank you very much for watching the video, and enjoy the rest of your Sunday. Thank you.